An index isn't a neutral list. The S&P 500 is picked by a committee and you pay for their judgment in ways your fee statements never show. But that's not the only way that index funds cost you. When are flowers the most expensive? Valentine's Day. Same roses, double the price. Because what the florist knows is that everyone has to buy on the same day. Index funds buy on a schedule the whole market can see coming, and they pay whatever's being asked. They have no choice. You cover the difference. Now, when is a stock the most expensive? The day it gets added to the index. Every index fund has to buy it on the same day if the stock is in the index's coverage universe and the rest of the markets knows it's coming. On top of that, funds like the S&P 500 have committees that oversee them, and in some cases choose not to include companies even if they fit the criteria. Those hidden costs never show up on your fee statement, but you pay it anyway. But active funds aren't any better. The Wall Street Journal just reported that over the last 12 months, nearly 75% of active funds failed to beat the S&P 500. And on average returns, that argument is settled. Index funds win. And I'll show you the Canadian data because it's even worse than the American numbers. But at the same time, index funds are multiplying faster than ever, riding the belief that all passive investing is automatically good. So here's the big question. Well, everyone's fighting over these two ways of investing, active versus passive. Is there a way that has historically outperformed both? And can you invest in it and still be heavily diversified? The answer is yes. But to understand why, we need to look at the research behind active and passive managed funds to find their upsides and downsides to determine what this third option actually needs to fix. Let's start with active and passive management. Active management is where a professional manager or a team of them makes the buy, sell, and hold decisions on what the portfolio owns, all towards a single goal, beating the benchmark without taking on extra risk to do it. So there's this time I was at a conference and I met an active manager and he was pretty young, like my age. And he put it like this: his fund aimed to win 70% of its trades because doing that would consistently beat the benchmark net of fees. Now, remember that number, 70%. Passive management, on the other hand, follows simple rules that track an index with limited tracking error, which is how far the index drifts from the index it's copying, also called index fund investing. Now let's go over the case for both and the research behind them, starting with active management. The case that active management makes to invest in their strategies isn't necessarily about winning when markets rise. It's more about losing less when they fall. The National Association of Active Investment Managers, which is a trade group for active managers, puts it this way: done properly, active management blunts the impact of bear markets and preserves your capital. And when the market turns back up, you've got more money to put back in. And that's worth something. If someone gets you out before the worst of a crash, you don't just lose less, you re-enter with a bigger amount of money. That's not a small thing, and that could easily justify a higher fee. Now, additional research and additional statements, they argue that a manager can be on the wrong side of the market nearly 40% of the time and still match a buy and hold return. They call it the buy and hold equalizer. Protecting capital does that much heavy lifting, and there's real research behind it too. An economist at the Federal Reserve named Pu Shen tested 5 market timing rules from 1970 to 2000. Simple ones based on earnings versus interest rates. And 4 of the 5 beat buy and hold higher returns and lower volatility. $1 in 1970 turned into $101. Buy and hold gave you 47. That's the case, and it's a pretty good one. And hold on to it because we're going to come back to it later. The second case is that markets aren't perfectly efficient. A perfectly efficient market would have every security priced exactly right, meaning the only way to beat the index is to bet on an unknowable future information. But even Eugene Fama, who created the efficient markets hypothesis, admits markets are never perfectly efficient. Personally, I hold to the weak form efficient markets hypothesis version. There are mispriced pockets, but they're very hard to spot beforehand and capitalize on. The third case for active management is the star managers. Think Peter Lynch in the 80s and more recently Mark Schmel. And surely their track record proves some managers are genuinely skilled enough to beat the market. And this taps into something real about our psychology and how we think. One of the biggest reasons Canadians choose active management is we want to believe that intelligence and risk-taking get rewarded. They're rewarded in almost every other area of life. So why not investing? Here's the problem. You should never judge a manager on a single year. You can't separate luck from skill that fast. So what about one who's beaten the market for 10 years? Studies consistently show that kind of persistence is pretty rare. Some managers are genuinely good enough. The hard part is identifying them in advance and needing them to have full discretion and stay small enough in their funds to move quickly. Now, if you got lucky and you found that manager ahead of time, hang on and enjoy the ride. The evidence just says they're extremely hard to find. Now, the downsides. First is fees. Morningstar's 2025 Canadian fee study says that the median active equity fund here charges around 1% a year. Canadian equity 1%, US 1.04, and global equity 1.08. And that's the unbundled version, meaning the cost of advice isn't even factored in there. Roughly $1 trillion of Canadians' money still sits in commission-based mutual funds with an advisor's cut invisibly baked into the fee. That's about $10 billion a year Canadians pay in embedded advice costs. Most people paying it don't even know it exists. Remember, fees are the only thing you can control in investing. You can't control returns. You can't control the markets. You can only control what you pay. Second, let's look at the scoreboard for active and passive. According to the latest SPIVA Canada numbers, S&P index versus active, in almost every category, between 83% and 100% of Canadian active funds lost to their index. And before anyone says it was just a weird year, over 3 years, 96% lost, 5 years, 96% lost, and over 10 years, 98% lost. It gets worse every year. Now, go back to that market timing paper, the one that found 4 of the 5 timing strategies beat an index, the whole active earns its keeping down markets argument. Here's what happened when the market actually crashed. March 2020, markets dropped over 30%, the exact scenario that active management's claim of value is to protect investors from. And 88% of actively managed Canadian equity funds did worse than the index over that 12-month period. So in the year where active kind of hangs its value proposition on, the 1 year they should have protected investors, 88% failed. So that's the problem with the strategy that works in like a backtest study. The backtest always ends. So when your advisor shows you a fund's beautiful 5-year track record, understand what you're looking at. You're looking at the past performance of a coin that happened to land on heads 5 times, and you're being charged 1% a year for the privilege of betting it lands heads again. Eugene Fama, Nobel laureate, the father of modern finance, summed up the entire profession of active managers in one sentence. I'd compare stock pickers to astrologers, but I don't want to badmouth astrologers. The case against active is very strong. Fees among the highest in the developed world in the Canadian market, and often hidden. A scoreboard where 85 to 100% lose to a fund you could buy for a 20th of the price, and the rare winners can't repeat it, so you can't pick them in advance, and neither can your advisor. So you've got a premium price, a product that loses to the index, and no reliable way to find the exception. So if active is that bad, then let's talk about the case for passive. We already know that active loses to it, but I'm going to go a step further and ask a different question. What do the financial professionals and academics who understand this stuff the best do with their own money? Let's start with the people who wrote the textbooks on finance. 3 researchers, Doran, Peterson, and Wright, surveyed over 4,000 finance professors. And these are the people that are training the future active managers. And they asked the question, how do you invest your money? Twice as many finance professors invest passively as actively. That's 2 to 1. And here's the crazy part. The professors who did trade actively weren't doing it because they'd found evidence it works. Their behavior was driven by the same thing that drives the people posting on Twitter or Reddit. It's confidence in their own abilities, not evidence, it's ego. So even amongst finance PhDs, the divide is the same. The evidence people index, the ego people trade. Paul Samuelson, the first American to win the Nobel Prize in economics, said the index fund belongs alongside the wheel and the alphabet as one of the great inventions. And then there's the big name, Warren Buffett, the obviously greatest stock picker who ever lived, arguably. In 2008, he bet $1 million that a plain S&P 500 index fund would beat any collection of hedge funds. The smartest, best paid investors alive, allegedly, over 10 years. One firm took the bet, the index fund made over 125%, the hedge fund made a fraction of that. Buffett won so badly that they actually conceded early. And then Buffett as well, in his own will, his instruction for his wife's inheritance, put 90% into the S&P 500 index fund. So think about that. The one man on earth who's got a proven track record, at least up into the early 2000s, of beating the market, looked at his own wealth and basically said, I don't even necessarily trust my own successor to invest this money for you, just buy the index. That's because he understands the evidence better than anyone alive. And he's even said in the past, he's only met 2 or 3 people in his life that could outperform the index. As well, people are starting to wake up to the fact that passive investing is probably a better alternative to active. Morningstar tracked 10 years of fund flows, and the cheapest half of passive funds captured 93% of all new passive money. The average dollar in a Canadian passive fund now pays 0.23% a year. The cheapest index funds as low as 0.04 against the 1% plus active fund that loses 9 years out of 10. And every time regulation makes fees more visible, things like CRM2 and now CRM3, more money moves passive. So passive doesn't grow through marketing, it grows through literacy, and ignorance is the industry's business model, and it's starting to run out. So here's the case for passive in one sentence. The more evidence a person has seen, the more likely they are to index. I think passive management is a no-brainer for the majority of people. In fact, I left an active management firm in order to go and use passive funds for my clients. I left one of the biggest financial planning and wealth management firms in the country to start my own firm because I saw the evidence. I saw what I've just presented to you, and there was no way around it. There's no rational way to look and say, I want my clients to pay 2% a year in fees in order to underperform what they could be doing by buying a simple index fund. Okay, so I've made the case for passive about as hard as it can be made because I really believe in it. So is that it? Buy the index, close the video, and go? No, because passive has its own fine print, and there's real limitations that most people don't know about. And I'm going to walk you through those limitations and then show you the strategy that the academic community pivoted to when new research came out. So there's 4 major issues with index funds. First is index funds can be expensive, but not in MERs. So remember the analogy with the roses, how it's like double the price on Valentine's Day? Again, when is a stock the most expensive? It's the day it joins an index. It's called index reconstitution. And the moment an index announces an addition, every fund tracking it must buy the stock the same day, basically for the same price. They can't wait for the price to settle. And they also have to announce that they're going to add the stock to the index in advance. And now that the market knows that index funds are going to be adding a stock, the traders buy it first. They mark up the roses or the stock and sell them to the index funds on delivery day. So take Tesla, announced in November of 2020 to join the S&P 500 in December. Between announcement and inclusion, the stock ran up sharply, largely because everyone knew that massive amounts of money was about to be forced through the door to buy the stock. On the day, index funds had to sell tens of billions of dollars of other stocks to buy it at whatever price Tesla was. So there's no discretion, there's no waiting. It was just an insane valuation driven up by the market, and you, the index fund holder, paid for it. The second issue is that a total market index owns the whole market, including a corner decades of research says is not great to own, small cap growth stocks with weak profitability. These are tiny companies, big stories, but no earnings. Falma and French found that this had been one of the worst performing groups of stocks in history. They behave like lottery tickets. They're exciting and occasionally spectacular, but terrible on average. A rules-based index can't skip them. If it's in the market, it's in your fund, a permanent slice of essentially a lottery ticket bin, and it can create a bit of a drag on your returns forever. The third issue is who decides what's in the index. You think the S&P 500 is a formula, top 500 companies by market cap and done, but it's not. It's a committee. It's chosen by people at the S&P Dow Jones in a room making judgment calls. There are criteria, but it's not known how much of the final call is rules-based versus human discretion. So again, Tesla qualified on the numbers in September of 2020, and then the committee said no, but 2 months later, they changed their minds. Nothing about a formula or rule changed, so people changed their minds. So do we trust a committee to never be politically pressured, to always be neutral, to never keep out a company that's fallen out of favor? If humans are deciding what's in your passive fund by discretion, that's a layer of active management hiding inside the world's biggest index. So how passive is the S&P 500 really? The fourth issue, it doubles down on whatever's expensive. Index funds are weighted by size. The bigger a company's market value, the more of it you own. So the more expensive a stock gets, the more of your money automatically flows into that piece. That's how a handful of giant tech names came up to make up roughly a third of the entire S&P 500. Your diversified fund of 500 companies is really just a bet on about 10 of them. And there's no mechanism to say that's getting pricey, let's reconstruct. So where does that leave you? Active sells you a forecast the evidence says it can't deliver. Passive sells you the market at a really low price with all that fine print. And there's a third option. It came out of the same research that produced the efficient markets hypothesis in the first place. In 1981, a researcher named Rolf Banz found something odd. Small companies had outperformed large ones for decades by more than their extra risk seemed to explain. And a company called Dimensional Fund Advisors opened that same year to try to invest in that strategy. It was built by David Booth. And that's the same Booth of the Chicago Booth School of Business, a student of Eugene Falma. So maybe these names are starting to stick together. Okay, so 11 years after Dimensional was formed, Eugene Falma and Kenneth French ended up doing some groundbreaking research all the way back to 1926. What they found was that investing in stocks beats investing in treasury bills. They found that value companies beat growth companies. They found that small companies beat large companies. And they found that high profitability companies beat low profitability companies. These are called risk factors. And they explained over 90% of the returns in a diversified portfolio. In a strategy like this, nobody picks a stock or makes a forecast. You just apply a rule to thousands of companies and end up owning more of the parts of the market that have historically paid you for taking risk. Now, since 1993, hundreds of factors have been published, and most are noise because academics love to data mine and basically torture the data until it tells them what they want to hear. So a factor has to clear a high bar. It has to make economic sense. It has to show up across decades. It has to show up in other countries and asset classes. And it has to survive the costs associated with trying to capture this risk premium. And only a handful clear it, and that list has barely changed over 30 years. Now, there is a catch with these factors. The premiums can disappear over a number of years and for long periods of time. When I say premiums, what I mean by that is it's the amount that exposing your money to the certain risk factor has outperformed just exposing your money to the total market. So that's what a risk premium is. Looking at the historical record, one of these factors was negative in nearly half of the rolling 10-year periods. And so that's obviously a trade-off. You get higher expected returns, and I'll get to that in a second, but it's bought with stretches of pain that you've got to sit through. The real question is, does it actually beat the index over time? So here's some data. $10 invested from 1927 to 2024 in 1-month treasury bills. That $10 turns into about $22. Invest that same $10 in the S&P 500, turns into about $11,758. That's the market factor. That same $10 in the dimensional US value index turns into about $33,000. So there's value factor. The value beats growth. In the dimensional small cap index, it turns into about $54,000. So there's the small beating large. And in dimensional's US small cap value index, it turns into about $161,000. So combine equity size and value, and you get massive outperformance over time. And there's another piece, and it's going again back to that analogy we talked about. An index fund has to buy what the index says on the day it says. That urgency is what the rest of the market front runs. A factor fund has no such obligation. It defines its eligible universe and trades inside of it. If a stock it wants is expensive today, it can wait until it meets its criteria. If someone has to dump a block of small cap value at a discount on Tuesday, it can be the buyer. So tracking error isn't necessarily the goal. So it never has to be essentially a sucker for the same day delivery we talked about. So Dimensional made this strategy famous by applying the research of Eugene Fama, Kenneth French, and other Nobel laureates who now advise the company. And they're who we use to enact this strategy for our clients. Since the research took off, Vanguard, Avantis, Fidelity, and others have all created factor portfolios as well. So here's what this all boils down to. Passive wins for most people. It's probably the right choice for the average DIY investor. But if you look closely, there are evidence-based reasons that certain factors, small, value, high profitability, have historically earned more than just the average index funds, even though there are real trade-offs along the way. So if you're earning six figures and are looking to diversify, we've built this factor-based portfolio management style directly into how we build our clients' portfolios because the evidence behind it is stronger than anything active management has ever shown me. If you want to learn more about how we build financial plans and portfolios for clients, click the link below, and I'll see you in the next video.